Welcome to the Accumulating Wealth Podcast. I'm Hunter Satterfield.
And I'm Judson Crawford. We're CPAs, wealth advisors, and partners at Kane Waters and Associates, a financial services firm here to help business owners navigate the decisions they face every day.
Yesterday, on September 17th, the Fed announced its first rate cut since the end of 2024, and some think it signals more cuts to come.
Yeah, a lot was covered in the post-meeting statement, so much we knew we had to bring in one of our regular guests to weigh in.
That's right. It's Brad. Let's go.
Let's go.
Well, Judson, we have Brad story time today. What'd you call it last time? Storytelling?
Story time with Brad, maybe?
Yeah.
I don't know.
All right. Do you want to go straight to it, or do you have something?
No.
Oh.
Before we get into it, all three of us have big matchups in college football this weekend. We've got the final. Brad's SMU Mustangs have the final Iron Skillet, one of the oldest rivalries in college football, SMU versus TCU. Fort Worth, right?
Yeah.
It's in Fort Worth this weekend. Sorry to see that storied rivalry go.
Kind of lame.
The Red Raiders, Texas Tech, playing the Utah Utes, number 16, number 17. I'm the only one representing, for those of you on YouTube, that is Raider Red right there. And then the Longhorns have Sam Houston State.
Big rival.
Huge rival. So
one of the biggest rivals.
2 picks.
Y'all are only 41.5-point favorites.
We are not going to cover that. That's my pick. We're going to win.
You're going to win. You're going to win. So maybe we go
cover that.
maybe we all win this weekend. SMU, UT, and
you know what?
I'm sorry, TCU, UT, and Texas Tech. Hunter did not pick Texas Tech in the pick'em, so he'll be wrong.
In honor of Brad being on here, I'm going ponies. All right. So there's that. How about that?
Do you have any opinions, Brad?
No.
A couple weeks ago, I would have said ponies, but then we just completely lost
Took
it against
the bid.
Baylor. So we'll see.
Well, folks, as in the intro, we're not going to just talk about football. We're actually going to dedicate this whole thing to the Fed cut. We got our first one in almost a year, Judson.
Yay.
And the market responded. We're going to talk a little bit about where the Fed was on things. But at first, I think we need to give ourselves our flowers here. We called it 25 basis points. And Brad, you had mentioned, I mean, you were in deep conversation with our fixed income managers. Mm-hmm. They largely pretty much said 25 basis points was coming, especially after the poor labor market, stuff had come out. And so that's what the Fed did. 25 basis points, right?
Yep. We nailed it.
So I think, folks, we're going to talk through a little bit. There is some everybody was unanimous on this. There was one person that dissented, though, on thinking it should be 50 basis points. But again, there was largely agreement on the Federal Open Market Committee. And so that's super important, and probably why the market responded as it did, which we'll let Brad talk about. I think the first thing to talk about is that periodically at these meetings, the Fed will actually update their forecast on various economic indicators. Yeah. And on this one, they actually updated 2 of them. So they took growth in GDP up from 1.6 to 1.8. Their June projection was 1.6. And then they took core PC inflation up from 2.4 to 2.6. So, Brad, they've got a dual mandate, which is employment and inflation, and that's the Fed's stated dual mandate that they're looking after. And here's the deal, right? Like in a situation where they're saying, "Hey, we expect GDP growth to be better than we thought in June. We expect core PC inflation to be higher than we thought in June." Those are not indicative of in any way that they should be cutting rates. If anything, they should be holding firm or even potentially hiking. So ultimately, why did the Fed decide to do the 25 basis points?
I think just the weakness in the labor market. That's the other half of their mandate. And, I can't remember if it was last month or the month before, we kind of had the brouhaha with the Bureau of Labor Statistics and Trump firing the head of that. And then we've since subsequently gotten revised data, which showed actually a dramatic decrease in jobs when they were reporting flat to slightly higher before. And so I think when they had that labor weakness, it gave them the cover to actually cut a little bit. There's been tremendous pressure, both politically and kind of geopolitically, because we were running higher rates than almost every developed nation at this point. So I think they were able to use that labor weakness as the backdrop to be able to start walking rates down. It does not surprise me at all that it was only a quarter, because of the 2 things you just mentioned, and also the market's at all-time highs. Generally, if you start cutting rates at all-time highs, you get a really good market for a year, and then it can go either way on you really quick. So they're going to be very careful going forward. So I would expect if any future cuts are going to be a quarter point at a time.
Yeah, and I think one of the things to your point is this is actually the first Fed interest rate cut with core PC at 2.9% or higher in 30 years.
Yeah.
I mean, it is definitely an abnormal, sort of outlier event. And so that is exactly what you said. It's got to lean into sort of the labor weakness that we're seeing. And I mean, again, Judson, we've talked all year about the headwinds against growth, whether it's immigration that will restrict labor, obviously, or tariffs that, could cause layoffs or have caused layoffs that also create some labor weaknesses. And then several others as well. So, I mean, I think that is absolutely the story. Now, Brad, we mentioned that there was one person that dissented and wanted to do 50 basis points. Did he indicate why he thought it should be 2 cuts instead of the 1?
I think if I'm remembering correctly, that was more like we're behind the curve due to inflation. I actually thought there was one more that was wanting to be more aggressive, and I think it was Trump's new guy that just got on there, so he was really easy to spot. But yeah, I think there was one that wanted a little bit more. I think the good part of this was there was nobody that said we shouldn't cut, and the market liked that because you saw some cohesion within the Fed. I think I think they were going to cut a quarter point no matter what. But if it came out where like 3 dissented and said no cuts, then the market would be materially lower because it would probably foretell that they wouldn't do any more this year and early next year. But I think that left that all on the table, and that's why the market liked it.
I mean, would you say, before we get to the market's response to it and then also what's coming later this year, I mean, would you say that the Fed, given, again, all these economic forecasts, is potentially concerned about stagflation still? I mean, is that something that they're seeing? I mean, we've talked at length here what is stagflation, but is that something that you think they're seeing and why they might do the cut as well?
Yeah, I think it's got to be in the back of their mind. I don't know, based on kind of Powell's comments, he definitely mentioned it several times, but there's not the level of concern that you might expect. And I think a lot of that has to do with when you start drilling through the CPI data, the mix of what's keeping inflation high. Like last report, it was a lot of services and stuff that are highly cyclical. It wasn't a lot of the durables that can really be persistent. It's stuff that's kind of flighty. And then also this tariff, the tariff stuff is I think kind of throwing a wrench in everybody's spokes. We haven't had tariff policy like this in quite a long time. So the models probably aren't handling it as well as one may think, that they're using to kind of base their decisions on. And, right now we haven't seen a lot of the pass-through inflation that you would expect, because when you import things, there's these intermediaries that kind of take it. And those guys are absorbing a lot of the cost right now. And I think a lot of why they're absorbing the cost right now is you have kind of a weakened U.S. consumer. If you look through all the consumer data, the consumer on average is tapped out, probably doesn't trickle down to like our clientele here. But the average American, his credit card debt's up, healthcare costs are up, inflation's up, grocery bills are up,
student loan payments
have come back, and then you have wages have, for most people, have kind of stalled out. So there's not a lot of discretionary spend there, and so I think like a lot of these intermediaries in this import export stuff are kind of eating the costs right now, but they will pass that through. That's not going to be permanent. But I think they know if they do it now, it's just going to lead to way lower demand, and it's going to cause problems here. And so they're just kind of eating it in the interim. So I think the Fed's kind of got that in the back of their mind. Like if they start passing that through, you could see inflation pick up really quickly. Now, it's not going to be, like it was in 2022 or anything or like that, but it would be, meaningful enough to where they probably wouldn't have the cover to cut rates anymore if that were to come online quickly.
Okay, so Brad, we all knew, we talked about it on the podcast, that they had really telegraphed the fact that there was a rate cut coming, and we kind of got what we wanted. And then on Wednesday, after the announcement, market popped a little bit, kind of sold off a little bit towards the end of the day, so there wasn't any major momentum going into the end of Wednesday. And then, of course, yesterday we had a good day in the market. So what does that tell you about what the Fed said, how the markets responded to it, and what we can expect going forward.
Yeah, I just think this rate cut was well telegraphed and priced in. And when one of the immediate things that happened when Powell started to speak is you had a pretty big sell off in the dollar, and so when you see that, it's going to cause markets to sell off some of the time because you're going to see if you see it tick meaningfully lower, foreign investors start pulling out, and so that's probably where a lot of that selling came from. Was just for because if the dollar's weakening and you're long dollars and you got to get it back in your own currency, so if you don't have a hedge on, and so anytime you have directionality in a currency like that, and then you have policy that kind of fuels that, it's going to cause that. So I think that was a lot of what happened. And to Hunter's point, the 10-year Treasury had gotten dipped below 4% briefly before that, so that had all been priced in. Those ticked up a little bit. I just think that there was kind of a sell the news kind of atmosphere to the whole thing. And then once everybody digested it overnight, you had, Powell's speech is like an hour. So if you're working during the day, you don't get to read that till you go home. Wake
Not
up.
with that attitude.
I listen to it, but most people probably can't. So when yesterday we saw things like small caps rally hard, and it wasn't necessarily Mag 7. It was more of a broad market rally, which you would expect because those things are going to benefit more from these rates cuts. And then, today markets all over the place, kind of flattish today. I think it was just priced, and then they're going to, as we get more economic data over the next couple months, getting in November's meeting, if we have some worsening labor statistics and things like that, then they probably would have a room to cut again. And to your point, that they basically intimated that there's room to do 2 more by year end. So that's going to be November and December.
So before we get to future cuts, Jetson, I have a question for you. Super important. Are you long or short the dollar?
Well, I mean, I think that long term, I think that I would probably, well, okay, let me restart the answer to the question. As of today, I'd probably short the dollar, right? Because the dollar has continued to go down consistently. And we've seen other assets that are, opposite of the dollar go up.
I'm long Bitcoin.
I mean, you're a long
Short the
Bitcoin,
dollar.
short dollar, long Bitcoin.
I mean, part of the reason the markets move around on this is people maybe forget this, but the U.S. is a net importer. So, we export 3 trillion a year and we import 4 trillion roughly. So anytime you see dollar weakening, that just means that, that $1 trillion difference of goods, they get more expensive. And then when you start layering tariffs onto that, that's part of what the Fed's looking at, like, okay, what could happen here? And it's just, that I'm kind of shocked that tariff stuff's still a little bit of the morass that it is. But it doesn't seem like it's going to be resolved anytime soon. So
on our predictions next year, we're going to just do long and short over and over again.
Okay.
Yeah, it's going to be great. So Brad, would you take the stance the Fed would you say the stance the Fed is taking is hawkish or dovish? Or would you say it's a different type of bird?
Bullish, bearish, hawkish, dovish.
I would say on the margin it leans dovish, but this is not. They're not going to get aggressive. And if you see them cut 50 basis points in November, in my mind, and this is my opinion only, the market's probably not going to respond as well as it did this time because it's going to mean that there's something going on that's not good. So why the Fed is cutting also matters. So if you got hot GDP, PCE where it is, markets at all-time highs, and they're cutting, and they're basically like, we don't have to be that restrictive here, then you can have a bullish tape. If they're cutting because, man, there was another big round of layoffs and all that, then that's going to start, then you're going to start hearing the Fed's way behind, they need to do more, and the market's probably going to start pricing some softness economically.
Now, to a degree, when we talk about the labor statistics, when the Fed started to increase rates, we knew that tightening the labor market was part of what happens when that happens. So, I mean, this can't be all of a total surprise.
No. And I think part of what we have with that labor statistic data is we still have like a lot of weirdness from COVID. I'll never forget trying to go through that data in 2021. I'm like, I'm just putting this away. It doesn't even make sense. And so I just think that, and then he did mention in his speech the other day that they feel like their data is good enough to kind of do their job. But he said, there's tons of firms that aren't reporting. So their data set has shrunk. And so they're getting a good enough picture of what's going on. But, you have to have firms like Kane Waters and stuff like reporting to the BLS, like, hey, we increased hiring and all this. And if everybody did that, you get a clear picture. You're never going to get 100% participation. But I think that's just dropped a lot. And then I think a lot of people are doing, gig economy type jobs that don't get counted and stuff like that. So it's just very confusing time. I'm hopeful that technology will kind of take over and make that a lot cleaner over the next few years.
We are hiring at Kane Waters.
Yeah, it's actually
You can find our job posted online if you are interested in a job at Kane Waters. Go to kanewaters.com.
That's a great segue there, Judson.
You're welcome.
So to your point earlier, Brad, you mentioned this, that, the Fed's a little bit split, but, I think we're broadly expecting maybe 2 more rate cuts before the end of the year. So 9 of 19 Fed officials see 2 more cuts in 2025. 6 of 19, 9 plus 6 is 15. I figured that one out.
Calculator.
Yeah. And they see no more cuts in 25. So, and then there are a couple that were, in between as well. So, I mean, they're split. And I think, again, your point is that any cuts will probably be smoother into the end of the year, but we probably have more on the docket for October and December. I think, though, this is also like that and stagflation and the Fed starting to be a little bit like, we don't really know what to do here because we've got this dual mandate and they're sort of competing. It probably leans why we've had volatility in the market the last 2 days, even though that volatility has been on the upside, and what we can broadly expect through the end of the year, right? Just a really volatile, choppy market, but probably on the upside.
Yeah, I think it's just going to be data-driven choppiness. You get a CPI number that's higher than expected. You get sell-offs. If it's lower than expected, you get euphoria, and then everything in between. We're going to get a lot of data the rest of this month and in October. But yeah, I do think the bias is towards the upside based on history. Normally if the Fed cuts near an all-time high in the market, the market's about 10% higher 12 months later. So
I actually had the stat, so
okay,
that's great. I'm glad you asked. So you're exactly right. So the last 20 times the Fed has cut with the S&P at a record high, the last 20 times, the S&P has risen 13.9% on average over the next 12 months, and every one of them has been positive over the next 12 months.
Yes.
Now, again, is there a black swan event we're not aware of? Are there extraneous factors? Because in this case, we actually have tariffs we're dealing with, immigration, definitely a new administrative policy in the White House. So this certainly could be the first of the 21 to go down. But again, broadly, it's higher double digits in 12 months.
I mean, cutting rates is stimulative at the end of the day. Banks will, stimulate to the banking system, stimulate anything. And with a weakening dollar, if you're a U.S. citizen, it behooves you to put your money in some assets and not let it sit in the bank, right? And we're still a consumer-driven economy at this point, so you want to have something that's going to preserve some purchasing power there. So it's going to cause people to invest. It's going to cause all that stuff. We do have probably more left tail events that could happen at this point, just because how things are geopolitically. You got the tariffs. You have some kind of policy kind of volatility going on in Washington. And I think just the mood is probably not as great as some of those last 20 times, particularly after the events last couple of weeks. But I would not bet against that. That's like a 1,000 batting average that, you don't bet against that kind of stuff. So yeah, I would think, probably sitting here this time next year, the market's double digits from here. It just may not feel like it's not going to be a straight line up for sure. I would bet that.
Yeah, and I think to kind of parlay with what you said, I mean, when we talk about rate cuts and we talk about what it really means for the consumer, which is really what it comes down to, is that we are going to see the return you get on your cash going down, right? We are going to also see for the average consumer, the charges you're getting on credit card or consumer debt going down. What you hope that means is like Brad said, you hope that means some investment. You hope that means some spending as well.
Yeah.
Right.
Yeah. And that's a great way to sort of close things out, because I think everybody's always like, oh, are the mortgage rates going to go down immediately? And look, so you have to understand, we've talked about this before. There's all kinds of factors that go into it. And in fact, after the cut, they didn't go down because they had already been going down. This was priced in. But the Fed, Brad, is headed toward probably 3.1% Fed funds rate in the next 12 months with these cuts.
Yeah.
And so we're not going back to zero interest rate policy by any stretch. But if we're in a 3.1, 3.2 Fed funds rate, we're probably sitting in the low fives on the mortgage market long term as it stabilizes. But that's still, I mean, as Judson said, like maybe things are coming down a touch, but we're still going to be able to get yield in the fixed income space. We're still going to see higher interest rate or higher mortgage rates than we saw, obviously, pre-cuts back in the ZIRP policy days. But I mean, I think that's probably where we're headed. It's just not going to get there linearly, correct?
That's right. And what you have right now is you have a variety of factors that the curve's steepening. So like people think, oh, the Fed cuts. You have to remember that's the very short end of the curve. That's all they control. And so the 10-year treasury is actually up a little bit since they cut. And the 10-year treasury is what basically all lending is based on. So even your mortgages, you would think it'd be the 30-year, but it's not. It's the 10-year. I think really instead of staring at like how we get there, it's the destination, not the journey. I think if you could just get a 5 handle on a 30-year mortgage, so anywhere in the 5s, you're going to start to see activity in that space, which has been dead for 3 years. That's a big part of our economy. So once you get 5 years, you know, by our math, that's where affordability starts to kick in versus rents. And then people can move again and maybe afford to do that they haven't been able to do if they were locked into smaller mortgages or lower mortgage rates. But I think any kind of pickup in activity there is beneficial economically. Because if you think about the housing market, you have builders, you have real estate agents, you have all lenders, like all of that has just dried up and there's been no activity. So just getting that to kick back in is really positive, and we're on our way to doing that. Hopefully late next year, early 2027, I would think. If we can get that the Fed funds rates down to 3, hopefully you would be in the mid to low 5s on a 30-year mortgage.
Well, I think that's a really good practical point to discuss with our clients is that yes, this is a good sign. You know, and if you have any floating rate loans that are tied to prime, obviously you're going to see an immediate impact with a quarter rate decrease. But if you're sitting there and you've purchased a home or you have had to refinance your home over the last 12 to 18 months, and you're probably sitting there, which very well could be at 6.5 to 7.5%, it probably isn't time to go out and spend money refinancing right now. Right. As Hunter said, we saw some decreases in the mortgage rates because of what they were projecting. But if you're really wanting to refinance, you probably want to wait a little bit longer and see what happens and see if those rates come down, see if you can get more of a material decrease on those loans before you go out, pressure bankers to reduce your rates now. That may be something that we're looking at doing more in 2026 than we're looking at doing for clients, in the fourth quarter of 25.
Yeah, my mortgage I had to move in 2022 is at like 6 1/8, and it's not even on my radar right now.
Yeah, the only situation I totally agree. The situation I had recently was somebody that was under construction loan on the 7s, and they were like, "What do I do?" And I was like, "You actually go ahead and move down into the low 6s because that 1% is a significant amount of money."
Correct.
But then from there, it's going to be slower ones, right? Just as you said, it's going to be slower ones, and you kind of wait for that final, hey, we're in the low 5s, and I think then you could do a full refi.
Because especially on the mortgages, if you're talking about corporate debt, you may be able to have a bank adjust the rate at no cost even sometimes. But if we're talking about mortgages, every time you refinance, it's going to cost you money, right? And so it's going to, you have to pay that off with the rate decrease. So you have to be a little bit slower on the mortgage refinances.
Yeah. So completing story time with Brad, I thought we would read Powell's last statement, which is pretty similar.
In full?
No. His last sentence of his statement, which is pretty similar to July, but I think it's a really good way, listeners, to frame up, sort of where the Fed finds themselves. And everybody was on board with a 25. But I think from here, it could be a little bit, there could be dissension on both sides. And here's his quote: "Risks to inflation are tilted to the upside, as we talked about. Risks to employment are tilted to the downside," which again represent their dual mandate. And he says, quote, "a challenging situation."
Yeah.
And I think again, we're Brad and his team, they were saying 25 basis points 3 weeks ago in talking to our fixed income managers. We will be here to sort of understand what this looks like over the next 2 Fed meetings plus early next year and give you guys, sort of the most relevant up-to-date things we can. But the Fed, Judson, is in a really sticky spot from here on down. So certainly a lot can change as a result.
That's right. So the one thing you can take away, the one thing you can count on is we will be here.
Right. And the Longhorns won't cover. Go Ponies.
All right. The best way to keep up with this is to subscribe to this podcast. That way you never have to miss future episodes. You can go back and listen to all the others. If you're enjoying us so far, leave us a review. We'd love to hear from you, and we really want to know. Have a question, comment, or suggestion for a future episode? Drop us a line at canewaters.com/wealth. We really do answer these, and we love to hear from you. And if you want to learn more about what we do when we're not recording these episodes, visit canewaters.com to see how we're helping our over 3,200 clients reach their long-term financial goals.